Evaluating the financial statements of a small business, if you're considering buying that small business, it's like going to a mechanic when you have a used car and saying, give me an opinion on this car. Is the motor sound? Is the transmission okay? Is there enough tread on the tires? Is this car gonna work as I think it will work? My name's Phil Iverson. I'm an accountant here in Chicago. We prepare financial statements, income statements and balance sheets for small businesses, as well as do the tax returns for them. If you like this video, please give me a thumbs up, like, and as well subscribe to my channel if you feel you get value from this video. The very first thing you should do when looking at a small business and considering buying it is evaluate the financial statements and ask the owners for the bank statements of that for the company bank statements. I would usually recommend a 24-month period. 2 years ought to be enough. In general, the financial statements will give you an entire picture of how much money the company is making, and also what is the financial position as of today for that company. How much is the company owed by the customers and other people? As well, what kind of liabilities does the company have? Do they have a bunch of bills and loans that need to be repaid in the short term? What types of things are involved with the company? On the income statement side, the very first thing I do when evaluating an income statement is I take the bank statements and on a columnar pad, a piece of regular accounting paper with a pencil, I write down the monthly deposits that are deposited into that master main checking account. We're going to assume for the purpose of this video that the company has one main account that all income, all monies are deposited into, and all expenses are paid from. Of course, there may be other accounts. There may be a money market account where you transfer money to and from. That money market account will earn you a little bit of interest. Maybe you have a payroll account or an investment account. But regardless of the number of accounts, the same principles hold true. You have to know where is the money going and what is the money for. By knowing the monthly deposits, I can then look at the monthly sales reported on the financial statements and get an idea. Is the deposits approximately equal what the sales are? If the company is on a cash basis, in theory, the deposits to the bank should equal the income, the monthly income on the monthly financial statements. Oftentimes, a company will report invoiced out invoices as income, an accrual basis of accounting. But still, even here, if they're using invoices to account for income, are the deposits fairly close to the invoices? Is there any variance that needs to be accounted for? And ask the owners, when you're doing this type of thing. Ask them, how are things handled? Anything that's deposited to the company, you should, know what that's for. Does the company have loans that are deposited to and show up in the bank? For example, if you saw one main deposit number for a particular month on a bank statement, one might be tempted to say, oh, gee, that month was fantastic. We made wonderful money. But you may find out that a large part of that was a loan that was deposited to the company. And certainly that's not income. When you're evaluating the expenses of a company, you should have a feel for what types of things are ordinary and customary. How much is the payroll for a company? How much does the owner or owners, how much are they taking out of the company? Has this changed in the recent, this year to last year? And if so, why? For example, if a company owner that currently owns the company and is selling his company, offering his company for sale, if he's taking half the salary that he took last year, is this an indication that he really just doesn't need the money? Or is this an indication the company does not have the money to pay him? So these are the types of things that you might want to be concerned about. On the balance sheet, the top line on a balance sheet is usually cash, and the number 2 line, generally speaking, is accounts receivable. When you're looking at buying a new business, an aging of accounts receivable report should be run. And here is the reason for that. If a company's accounts receivable balance is $400,000, and you run an account receivable aging report, if $200,000 of that is for monies that haven't been paid to the company for the last 120 days, you have to ask, is this a reasonable number that we're going to collect in the future, or are these bad debts? If somebody hasn't paid in 4 months, there's a reason for that. And what is the reason for that? Also, you should have an idea of what's the average collection period for a company's invoices. So, because that's a crucial a bit of information. On the liability side for a company, how much debt is the company in? How much do they owe? And this should be a clear number. If a company has deposits that are these loans, who are the loans from? And what is the schedule for paying those loans back? Are they short-term? Are they going to be due this year? Or is it a long-term debt? There are many things that should be done when evaluating a company who is that is for sale, evaluating the financial statements. These are just a few. But certainly, if you're thinking about spending $100,000, $200,000, $1 million or more dollars, even if it's $10,000, you should have a pretty good idea of what is the financial position of the company, and how does the company operate with their finances. Again, my name is Phil Iverson. I am here in Chicago. I'm an accountant. If you're thinking of using an outside accounting service, we would love to hear from you. My contact information will be appear shortly after this video.